All right. Good morning, everybody. It is FOMC. Started yesterday. They'll finish today. 2 o'clock. They'll release the notes. Well, not the notes. They'll release their release. The markets will react to that. Algos, most of it. And then at 2:30, Powell will come out, chipping teeth. The markets will respond to that. And then usually by about 3:15 or so, we'll get the final part of the move, whether it was up or down, and it'll stick that direction into the close. Now, there's no guarantee that price is going to do that, but if you go back and look at previous FOMCs and kind of try to map out what price does, not necessarily it went up every time, it went down every time. It's what was the stages, what happened at 2, big move one direction or the other direction. How did it settle after that big move? And then at 2:30, when Powell starts talking, we get a couple of fake outs, big directions one way, big moves the other way. Then after 3 to 3:30, what's the final move? And it goes into the close. All right, so it's not as random as it appears. Maybe at first glance, you kind of get a feel for when that point in the day where the market just accepts whatever it is that they're going to accept, and everybody gets on one side of the trade. What you're looking for is that there's nobody taking the other side, right? One-time framing features, everybody moving in the same direction without a counterparty. It's not as hard as it sounds once you have it in your mind to look for it. Taking a look at what's going on around the world, small caps are down the most, 0.75%, followed by the NASDAQ, then the S&P, and then the Dow down the least. Everything is down. Hong Kong and Japan running pretty close together at about 0.25%, but even Europe down. So yeah, you know, we're on hold, we're on wait. We've got a lot on the table today, not just FOMC, as if that isn't enough anyways, right? So we got the ADP report today, and that's a really big deal. We've also got other jobs data and manufacturing PMI. So it's a full house today. I can't stress enough that if you're not a successful trader already, that today would be the sort of day that you really don't want to try to trade, right? I'm not saying that we shouldn't trade at all. Just that if you're already struggling, don't do the hard stuff. Today is very likely going to be one of those days that you can mark in the books as hard stuff, right? To me, it's just probabilities, you know. So when we go to FX Street, this is where we can see different economic events for today with a weight next to them. We get these impact bar. I like this website, especially for newer traders, since newer traders aren't necessarily up to date on which economic events could be impactful, which ones they should be nervous about, and looking ahead in concern. So, you know, if you are newer and there's so many economic events and you know, you're not quite sure which ones you need to be worried about, this is a really good place to go, and it's free, right? You don't need an account. You don't even need to sign up. In fact, I would encourage you not to sign up here. These guys are just horrible when it comes to email. They'll bomb you like spam mail. It just doesn't stop. So it's not worth it, right? Unless you're actually going to purchase their services, then that'd be something else. But you don't need an account. So you can see ISM, high impact. The FOMC today, high impact. ADP, high impact. It's going to be one of those days, yeah. And then tonight, like a really, really big deal tonight, 10-year Japan. Yeah. Yeah. Sure. Spot gamma levels for today if you want to catch a screenshot. For the SPY, and I'll do the Qs next. Somebody asked me the other day if I was going to spend money on a service for day trading / 0-day trading, out of everything that I've come across, what would be cost effective and useful? And it would be this right here, Spot Gamma. They literally have 0-day tools built into the system. Maybe I'm speaking too soon. It's the other one. The Trading Tick. Trading Tick has 0-day tools. Yeah, it's Trading Tick. And that's kind of the go-to, right? If you're focused on day trading and using 0-day tools and you're looking for a product designed for that, that would be this. Now, learning how to use it, you'll need some time. But 0-day flow, 0-day GEX, market DEX, I mean, this whole tab here is nothing but focused on 0-day and day trading. And then, you know, they got all these tools. So it's all in one thing. All right, 8:15, 8:30, 9:45, 10, 10:30, 2, 2:30. My goodness, I'm telling you. It's not uncommon for traders to just step out on the week, just back away, take a vacation. All right, we got to the 50% mark yesterday. And I'm going to put that on the intraday chart here for a moment, just so we can see what it looked like when price come up in there and hit that level yesterday, and how it took that rejection. It was a reasonably decent first touch play. It doesn't show it here, but that 50% level was absolutely worth keeping our eye on, 4206. And it looked like we were going to keep it when we came down and retested it later in the day, but we didn't. And you can see how we were struggling with it again in the overnight before we finally gave it up and dumped back down through it. So that level has kind of lost its value. It's still a go, no go level though. So, you know, whether we close this week above it or below it is still going to matter, but that is closing for the week above or below that level, and it's not really going to matter today. And now that we've crossed through it a couple times on the intraday, it doesn't have as much value either. So it's still 4,200 basically. You can keep your eye on that. And 4,211 is the cog line. We're also tangled up with those 50-period moving averages on the weekly right there. So there's just a lot right around that 4,200 area. If we bring it into the daily chart, we have the 10-period, 10-day, or the 50-week, kind of the same level. It's not perfect, but you know, generally lines up pretty close. So there's your 10 days. They are nearly stacked on top of each other. So it doesn't matter if you're going to look at the EMA or the SMA or do what I do and just put them both on there. We did get that gap closed. So the 4,211 gap close is done, but 4,211 is a cog line. We would keep it on there anyways. This is like a textbook bear pennant. If we get the failed flag play or pennant, it doesn't really matter. The idea behind this setup is how patterns evolve, right? If this is going to turn into a big cup and handle, we would first need a trend to the downside. We would need to build a base, aka a pennant or bear flag. That would fail. We'd come out the other side, come back up into resistance, take some of that resistance, which would give us the handle, and then we'd get the breakout, right? It all evolves one step at a time. Kind of looking ahead, thinking ahead, what is this going to turn into? If this does turn around, it would turn into that cup and handle. So one step at a time. We need to break this zone and negotiate with October 25, 50% line in the sand. 42.38. That's going to be the target if we do break outside of yesterday's price. So get above Halloween, target 42.38. Then target the high 42.73. Level by level, that would be the 20-period daily as well. So it's going to be a bit of a struggle. To the downside, we would just take this entire zone and continue it down. So 50% and 100%, 40.38, and then 39.50. Boy, it's been a while since we talked about 39.50. 39.50 lines us up with March. Really nice how confluence works. We do still have a consistent, persistent downtrend. Nothing has changed yet. We don't have anything in the price patterns that would suggest that we're done. We do have a bit of a leg here. So if we were to go into the smaller time frames, like an hourly time frame, measure that leg, 41.68 needs to hold. Now it's a long ways off. It's way down here. So, you know, from that perspective, it should hold, but that's the half back. So when we move back towards that 41.68, we can bounce on it. We can cut through it. Liquidity resides on the other side of the pivot. So we can cut through it. We just don't want to close below it. If we do close below it, that's a half back break. We would target 41.45. Otherwise, if it holds, we'll target 41.92 and then back up to 42.11 cog line. The volumes are within the normal range, but just barely. If we to come in just a little lighter, we'd be talking about the extra low volume. The thing is, this is just our gauge. It gets our attention. If the volume was light, we would want to know why. Of course, we know why, right? It's FOMC day. We got all this different economic events. But if there wasn't anything on the table and we came in and we seen the volume this light, we'd be a little concerned. And that's the point. Now, since we know it's an econ day, seeing the light volume makes sense. So we don't really need this tool this morning. it just doesn't fit here. And that's kind of the idea when it comes to using moving averages and any other indicator, right? It's just any indicator. I continue to see people say, you know, indicators are worthless, don't use them. And then the other side, indicators are everything. Why wouldn't you use them? They're not always going to give you a signal. There's times where you just shouldn't use the indicator, like this morning with that volume. 10-day, 30-minute volume profile. When we're at the highs, we go to the lows. When we're at the lows, we expect to go to the highs. The point of control has still not come down to us, either A, because we didn't spend enough time in one spot, B, the low volume, C, all of the above. We are above the highest spot where we were anticipating that point of control to come in, that 41.87 area. So unless we go back down into 41.87 again and continue to build more volume up at that location, it's unlikely that we're going to bring that point of control down. The thing is, that's where there is the most volume happening. So it wouldn't surprise at all if we go back to that spot. It's where the greatest amount of trades has taken place. So it implies people want to trade there. It's very likely we're going to go back there. You can see it's yesterday's point of control. Speaking of, it hasn't been hit yet today, which makes it a VPOC, and we would carry that forward. We now have two VPOCs underneath us. We did hit that 42.11 VPOC yesterday. You can see how just absolutely fantastic that was. Those cog lines are amazing. But we're done with it. Don't need it anymore. Take it off. We're never done with 42.11. It's a cog, C-O-G, but we're done with that VPOC level. The next VPOC level to the upside is 42.71, so a long ways off. That 41.90 is just about ready to be hit. You're going to get a taste of first touch rejection. At least that's the plan, right? And I'm not quite centered on that. Seems like I'm a little off. I usually just wing it. 41.90 and a half. That's close. So we're not as close to it as I thought. I just wasn't quite centered. We made it to the edge of the weekly expected move yesterday, and I kind of felt pretty good about that. On Monday, I mentioned in the last few FOMC days, on that Monday when we came in, I would sit there talking about the precedent of sitting sideways, waiting on FOMC and the market not moving, and how that hasn't really played out over the last few FOMCs, that we've actually gone to the edge of the expected move. I gave the warning then on Monday that even though our base case estimate for an FOMC week is that Monday and Tuesday we will sell into strength and buy into weakness and hold the range into FOMC, but I'm kind of thinking we're just going to go to the edge of the expected move since that's what we've done in the last few. And here we are, went to the edge of the expected move for the third FOMC in a row now, I believe. Don't quote me on that. I could be off on my numbers, but this is why, and this isn't seasonality per se. This is why we look back and we evaluate what has happened before, so we get a better feel for what could happen this time. Cool, cool. I like it, but I'm a nerd. We're still 2.5% below the 10-week. We are trying to bring the wave back from the depths from below 4. but it's still got a long ways to go. Bring it to a daily, and we can see that we're much closer to the zero line, but we're starting to move back in the other direction. So, you know, a decent general wave should just be a nice uniform move. We want to see it, you know, cut below and then back up and then cut below again, because that's, you know, a nice clean wave. What we don't want is that we start making our way back up and then lose it, and then have to start making our way back up again. So we were making our way back up. We're starting to lose it just a little bit there. The main takeaway at this point, when we're looking at this, we're not overbought and we're not oversold. We didn't move too far. We didn't move too fast. It doesn't owe us a reversal. Mean reversion tactics are not in effect. And that's the number one thing that we look at here. That's the main takeaway, right? Gauging the distance from this 10 directly connects to mean reversion tactics and whether or not we're going to see any of them. We're not going to see any of them. There's no reason to cut through the quotes tab today, looking at what is up and what is down, because it won't matter today. Any sectors that are leading or any sectors or industries that are not, you know, which ones are up, which ones are down, is very likely going to change as the data wears on, and they're just going to be tossed about by the economic data points coming out like a storm. So we won't even waste time with it. Just keep your eye on the clock today. Trade in groups, right? Pot stocks, EV markets, semiconductors. If you're going to be day trading today, trade it in groups. That'll be your best defense. Or trade the outlier. All right, and that really isn't a bad way to go. Find the one thing that's doing its own thing and trade that. Especially to the upside, there's a lot of traders who don't want to use options and they don't want to short. So they only day trade long in stock. And when there's only one or two names that are moving, and they're the high profile names because they're getting attention, everybody will trade that thing and it will really go. It's what we've seen before. It's what we'll see again. That's generally how it works. Everybody be careful, be safe. I will see you all tomorrow.